There is a specific group of people who got it right about the single biggest financial story of the last 15 years. And what they are doing now with that money is something almost nobody is talking about yet. They got called crazy back then. Bitcoin at $500. Play money, 1,000. A bubble. 5,000. Definitely the top, everyone said. 20,000. Pure mania. And then 100,000 happened. The people who held through all of that, through family group chat ridicule, through 80% crashes, through headlines declaring it dead, through years of being quietly laughed at, they built wealth that most people will spend a lifetime chasing. And now those same people are making a move that almost nobody outside their circle is paying attention to. Those same people, the ones who turned $5,000 into $500,000, who held through the crashes, who understood something about monetary systems and value before the mainstream did, are quietly accumulating silver. Not posting about it, not making it a personality, not going on podcasts to explain their thesis, just buying, quietly. The same way they bought Bitcoin back when the price was low and the mockery was loud. And the pattern is specific enough, and the reasoning is consistent enough that it is worth stopping to understand exactly what is driving it. What does a generation of people who already won the hardest financial bet of the last 15 years see in silver right now? And why are they making this move without any noise about it? That is the question this video is going to answer, not with speculation. Not with predictions, with the documented logic behind the move, the data that supports it, and the framework that Warren Buffett himself used to make this exact same bet in 1997. If this way of thinking about money is new to you, subscribe to this channel. This is where we break down how the financial machine actually works, in plain language, without the jargon that keeps most people on the outside looking in. Now let us start with who these people actually are, because understanding the source of this movement matters before we look at the movement itself. Here is the detail that most people miss when they hear the phrase Bitcoin winners. They assume it means speculators who got lucky, people who bought on a whim, rode a wave, and happened to be in the right place at a chaotic time. But the specific group driving the silver move is a different profile entirely. These are people who did the reading, who understood the monetary argument before the price validated it, who bought not because they thought they would get rich, but because the logic of a fixed supply, decentralized currency made sense given what they understood about how governments manage money. The luck was secondary, the framework was primary, and it is that same framework, not the luck, that is now pointing them towards silver. Picture the person? They found Bitcoin somewhere between 2013 and 2019, not through a financial advisor. Advisors were not recommending it then, not through a headline. The headlines were mostly warning people away from it. Through a forum, a podcast, a friend who would not stop bringing it up at dinner. They read about it, they understood the argument. They bought small amounts consistently through years when the price made no sense to anyone outside that world. They held through the crashes. They kept going back to the original thesis to test whether it still held. It did, and they held. The numbers tell the rest of the story without embellishment. Bitcoin went from around $1,000 in early 2017 to nearly $20,000 by December of that year, then crashed to $3,200 by late 2018. Anyone who held through that, a drawdown of over 80%, and kept buying was not doing it because it was comfortable. They were doing it because they believed the thesis. By the 2021 peak, near $69,000, someone who had put $10,000 in during 2017 and held through every correction had a position worth somewhere between $300,000 and $600,000, depending on their exact timing. By late 2024, when Bitcoin crossed $100,000 for the first time, The numbers for the long-term holders had become genuinely life-changing in ways that no other asset class had produced for everyday people in living memory. The profile of this investor is worth understanding clearly. These were not day traders, they were readers. People who consumed hours of content on monetary theory, on Austrian economics, on what the Federal Reserve actually does and why. They understood, before most people had even heard the word, what quantitative easing meant for the purchasing power of their savings. They were drawn to Bitcoin not as a lottery ticket, but as a logical response to a monetary system they had studied and understood. That same intellectual habit, reading primary sources, following arguments to their conclusions, acting before consensus forms, is what is now pointing them toward silver. Now here is something you need to pay attention to. You would think the logical next move for someone who experienced that kind of return would be to double down. Find the next asset with the same risk-reward profile. Go bigger. Add leverage. Push for even larger numbers. That is what intuition suggests. Intuition in this case is wrong. The people who have actually lived through a genuine wealth-building cycle, who have watched their accounts cross thresholds they never expected to cross, describe a specific internal shift. The drive changes, the goal changes, the calculation behind every financial decision changes. If that shift makes sense to you, if you understand what it means to finally protect what you built, write in the comments, "I protect what I build." There is a concept in behavioral finance, sometimes called the arrival threshold. When someone crosses a significant wealth level, the brain gradually stops optimizing for maximum possible gain and starts optimizing for not losing what has been accumulated. This is not fear of the market, it is not pessimism or failure of nerve, it is intelligence operating at a different register than it was when the portfolio started. The game shifts from offense to defense, and the players who recognize that shift and adjust accordingly are the ones who hold the money across decades instead of giving it all back in one sharp correction. The ones who do not recognize the shift are the ones you hear about later, made it, lost it, back to zero. Buffett has said this more clearly than almost any other major investor on record. His first rule, the one he returns to in every context, every shareholder letter, every interview he has given, is not about finding the best return. Rule number 1, never lose money. Rule number 2, never forget rule number 1. For someone who turned $10,000 into a life-changing number through Bitcoin, that rule stops being a quote they have heard before and starts being an operating principle they finally understand at a visceral level. They have the money. Keeping it is the new objective. Think about how a ratchet wrench actually works. You apply force in one direction and the bolt tightens. You pull back to reset your grip and the bolt does not loosen. The mechanism is built specifically to hold the gain, to preserve the progress, to prevent any reversal of the work already done. That is what serious investors look for after a high-velocity win, not something that can multiply their money another 100 times, something that cannot go backwards. For this specific group, hard money thinkers who already understand monetary history, who already understand that finite supply creates durable value, silver functions as a ratchet, physical, tangible, not dependent on a network staying operational, not subject to a protocol decision or a regulatory ruling made on a single afternoon. Now here is the first thing most people say when they hear this. Silver does not move like Bitcoin. The upside is not the same. It is boring. And that is precisely the point. These people are not looking for another 100x. They have already had it. They are looking for an asset that holds value without requiring technology adoption to stay intact, without exposure to exchange collapse risk, without vulnerability to a regulatory decision made overnight. Boring, to someone who has already experienced extraordinary, is not a criticism of the asset. It is the primary feature they are looking for. The framework has changed. The tool needs to match the new objective. If this is making sense to you, if you are seeing the logic behind why the structure of silver's market is different from most assets, let me know by hitting the like button. It tells me this kind of content is reaching the right people. Consider what silver has actually done across the full arc of recorded history. Roman legionaries were paid in silver denarii. 1 silver denarius, roughly equivalent to 1 ounce of the metal, was a day's wage for a skilled soldier in the Roman army. 1 ounce of silver today trades at around $30. A day's minimum wage in the United States is between $60 and $100, depending on the state. The ratio has compressed over 2,000 years of economic upheaval, of empires rising and collapsing, of currencies being created and destroyed. But silver and a day's human labor have remained in a recognizable relationship throughout all of it. No fiat currency printed by any government in that time frame can make a similar claim. That is the signature of an asset with durable intrinsic value. Here is the mechanism behind that stability. Silver cannot be printed. A government can issue more currency whenever it chooses. And governments do this constantly, especially in periods of economic stress. The Federal Reserve expanded its balance sheet by nearly $4.5 trillion between 2020 and 2022 alone. But no government can print more silver. The supply is geological. It comes out of the ground at a rate determined by what miners can physically extract from ore deposits. That rate changes slowly, regardless of what demand is doing or what policy decides. That physical constraint is the foundation of silver's long-term value. And it becomes significantly more compelling when you understand what is happening on the demand side of the equation right now. Silver is not just a monetary metal anymore. It is a critical industrial material in a way it has never been before in its entire history. Every solar panel produced today contains approximately 20 grams of silver, and there is currently no substitute that delivers the same electrical conductivity at scale. Electric vehicles use silver extensively in battery management systems, circuit boards, and electrical connections throughout the vehicle. Medical devices use it as an antimicrobial coating. Modern semiconductors are built on silver contacts. The Silver Institute estimates that industrial applications now account for roughly 55% of all silver consumed worldwide each year. And that percentage has been rising as the global energy transition accelerates. This is structural demand, not speculative sentiment. It grows with every solar panel manufactured and every electric vehicle that rolls off a production line. Here is where the supply-demand math becomes specifically worth paying attention to. Global silver mines produce approximately 800 to 820 million ounces per year. Industrial demand alone consumes roughly 600 million ounces annually. When you add investment demand on top of that and account for the fact that recycled silver does not fully bridge the gap, what you get is a structural deficit that the Silver Institute has documented across multiple consecutive years. The market has been consuming more silver than it produces. And unlike a manufactured product, you cannot simply decide to produce more silver faster. The geological timeline does not respond to quarterly earnings calls. The lag between rising demand and new supply is one of the most consequential factors in this entire equation. Opening a new silver mine from initial discovery through permitting, construction, and first production typically takes 7 to 12 years. You cannot respond to a demand spike the way a factory responds to a sales increase. That lag, between demand accelerating now and supply potentially catching up years from now, creates a pricing window. And sophisticated commodity investors look for exactly this type of window because it is where the pricing asymmetry tends to be largest. If you have been trying to understand how to actually position yourself, Not just which assets make sense in theory, but how to build the structure around your specific situation. Check the first pinned comment below this video. It is there for people who are serious about taking the next step. Look at the gold to silver ratio. It measures how many ounces of silver it takes to purchase 1 ounce of gold. Across centuries of monetary history, that ratio averaged somewhere around 15 to 1. The Roman Empire set it legally at 12 to 1. In the early 1980s, even within the modern era of financial markets, the ratio was in the range of 30 to 40 to 1. Today, the ratio sits at roughly 85 to 90 to 1. That means silver is historically cheap relative to gold, not in terms of absolute price, but in terms of its historical relationship with the other major monetary metal. If that ratio narrows even partially, not to 15, not to 30, just to 50, the arithmetic for silver investors is meaningful. And here is the specific reference point that the Bitcoin investor community tends to connect with directly. Warren Buffett made exactly this calculation in 1997. Through Berkshire Hathaway, he accumulated 129.7 million ounces of physical silver, one of the largest documented silver purchases ever made by a single investor. He disclosed the position publicly in 1998 and explained the reasoning plainly. Silver was fundamentally undervalued relative to its industrial and monetary role. The supply situation was structurally constrained, and the asset could not be replicated by government policy. He held for years. He eventually sold during a price surge, and Berkshire made a substantial return. The reasoning behind the original position has not changed. If anything, the industrial demand component today is significantly larger than it was when Buffett made that move. Price is what you pay. Value is what you get. When the price is in the 30s and the value case involves 2,000 years of monetary history, a structural multi-year supply deficit, a critical role in the global energy transition, and a gold-silver ratio at historic extremes, the gap between what you are paying and what you are actually getting is the entire investment thesis expressed in a single sentence. The Bitcoin community understands this gap in a specific way that most traditional investors do not. Early Bitcoin adopters spent years watching the gap between Bitcoin's intrinsic value case and its market price close, slowly, then suddenly. They know what it feels like to hold something the market is mispricing, to have done the analysis, to believe the thesis, and to wait while the broader world catches up. They are looking at silver right now and recognizing the same pattern. The price does not yet fully reflect the structural reality of the supply-demand situation. The ratio does not yet reflect the historical relationship between silver and gold. And patient capital, positioned correctly before the gap closes, is what captures the move when it finally comes. Here is what actually happens when someone crosses a genuine wealth threshold through a high-conviction bet. They get quieter, not secretive, just calibrated. They stop posting portfolio updates on social media. They stop engaging with every market noise cycle. They start having different conversations with a smaller circle of people paying attention to the same underlying signals. And in those conversations, across 2023 and 2024 and into 2025, silver started coming up repeatedly. Not in the public forums, in the private chats, in the Telegram groups and Discord servers that had spent years talking exclusively about digital assets. The conversations were shifting in a specific direction. Picture someone you might actually know. He bought Bitcoin in 2020 during the lockdowns, when he had time to read and the world had gone quiet enough to think. He found the monetary argument. He understood it. He held through the 2022 crash when Bitcoin dropped from nearly $70,000 to around $16,000, and every financial headline declared it permanently dead. He sold a portion of his position in late 2024 when the price crossed 100,000 for the first time. He's not rich in the way that makes the news, but he has more invested capital than everyone in his family combined has ever had at one time. And the first question he starts asking the people he trusts is this: what do you actually know about silver? That conversation is not hypothetical. It is happening in cities across the country right now, in hundreds of kitchens and living rooms and phone calls that will never make a headline. The people having that conversation are not on Reddit looking for the next coin with 100x potential. They have already had the moon shot. The conversation has fundamentally shifted to something more durable. How do you hold what you built in a form that does not depend on a system that can change its rules overnight? That question, asked by someone who already understands monetary history, who already understands what governments do to the purchasing power of the currencies they issue, points toward physical assets with long historical track records. Silver checks every box that framework requires: monetary history, industrial scarcity, a supply chain that cannot be accelerated by policy, a price accessible to virtually anyone who decides to start. The purchasing and search data is consistent with this pattern. In 2022 and 2023, as the crypto market corrected significantly from its 2021 highs, sales of physical silver through major dealers increased noticeably. The United States Mint reported elevated Silver Eagle sales during that period. Coin shops around the country described new customer profiles: younger buyers, unfamiliar with the traditional precious metals purchasing process, asking specific questions about physical delivery and secure storage. The demographic overlap with active crypto investors was visible enough that industry observers started noting it in public conversations. The rotation from high-velocity assets into hard stores of value is not a new phenomenon, and it is not a coincidence that it happens after the same kinds of cycles. After the dot-com boom of the late 1990s, a significant portion of technology investors who had made real money in internet stocks moved capital into gold, real estate, and commodities. The logic was identical. We made substantial money in something speculative and fast-moving, and now we want something that holds regardless of what the market does next. The people who were early on the internet understood that gold had been in use for 5,000 years and was not going anywhere. Those allocations to gold and hard assets in the early 2000s looked conservative at the time. A decade later, they were among the best financial decisions of that era. The Bitcoin investors looking at silver in 2024 and 2025 are running the same framework applied to an asset with an industrial demand profile that gold does not have, and a price point that makes it accessible in a way gold is not. Let us address the objections directly because they are real, and each one deserves a real answer. First objection: silver has already moved. The gold-silver ratio is still at 85 to 90 to 1. The multi-century historical average is 15 to 1, even accounting for the fact that modern financial markets may never return to that extreme ratio. The gap between current pricing and any historically reasonable convergence is substantial. If the ratio moves to 50 to 1, not close to historical extremes, just moderate convergence, the math for silver investors is meaningful. The window may be narrower than it was at the 2020 lows. It has not closed. Second objection: silver is not Bitcoin, and the upside is not the same. That is correct. This is a completely different category of asset with a different risk profile and a different role in a portfolio. Someone who already made their Bitcoin return is not replacing one speculative bet with another. They are adding a store of value layer that does not depend on technology adoption curves, does not carry regulatory shutdown risk, does not require a network to stay operational. Different job, different tool. Expecting silver to perform like Bitcoin is the wrong question. The comparison itself is the mistake. Third objection, silver is harder to sell than Bitcoin. Physical silver is liquid. Every coin shop, every major precious metals dealer, every exchange platform takes it. The spread between buying and selling is wider than in crypto markets. That is true. But the underlying asset cannot go to zero. It cannot be hacked. It cannot be delisted because a regulatory agency changed its position. It cannot collapse because the exchange holding it made bad loans with customer funds. The liquidity trade-off is the price of owning something with zero counterparty risk. For people who have watched a major crypto exchange collapse, and many Bitcoin investors have direct experience with exactly that, that trade-off looks very different than it does for someone who has not lived through it. Pay attention to this final objection. What if the industrial demand case takes a decade to fully play out? That is genuinely possible. Buffett bought his silver in 1997 and held it for years before the price reflected his thesis. Patient capital is called patient for a reason. The investors accumulating silver right now are not positioning for a move in the next quarter. They are positioning for the intersection of a structural supply deficit, a growing industrial demand base, and a gold-silver ratio that historically has always eventually normalized. Early money arrives before the broader market recognizes the underlying reality. That is the structure of how every major financial move has played out throughout history. Now let us make this practical, because the logic only matters if it translates into something you can actually act on. Silver trades at around $30 per ounce, give or take, depending on when you are watching this. $100 gets you 3 ounces of physical metal. $1,000 gets you 30 ounces. You do not need to have made a fortune in cryptocurrency to participate in the same logic that is driving the Bitcoin winners towards silver. The entry point is accessible to virtually anyone who takes this seriously, and the methodology that worked in Bitcoin, consistent, patient accumulation over time rather than trying to time a perfect entry, works exactly the same way here. The physical distinction matters and is worth being specific about. There are financial products called paper silver, ETFs, futures contracts, certificates that represent silver without giving you the actual metal. The sophisticated investors making this move are buying physical. American silver eagles, Canadian maple leafs, generic silver rounds from reputable dealers. The instinct that made them successful with Bitcoin is operating here. They want the underlying asset itself, not a paper claim to it. A certificate representing silver carries counterparty risk. Physical silver in your possession carries zero. The metal is the asset. Dollar cost averaging applies here exactly the way it applied in Bitcoin accumulation. You do not need to call the timing of the gold-silver ratio convergence or predict when industrial demand will tip the supply-deficit math into a visible price move. You allocate a fixed amount each month, $50, $100, whatever is sustainable for your specific situation, and you accumulate over time. Your average acquisition price smooths out across the cycle. The position builds without requiring you to be right about timing. It is not exciting. It is not a conversation starter at parties. And it is exactly the discipline that built the wealth in the first place. The storage question that most people overthink is simpler than it sounds. Small amounts of silver can be stored in a home safe or a lockbox. For amounts that go beyond a few $1,000s, allocated storage through a reputable dealer is a straightforward option. The key word is allocated, meaning your specific silver is identified and set aside as yours, not pooled with other investors' holdings. This mirrors the same principle that drives the physical over paper preference, direct ownership of the underlying asset, not a proportional share of a pool that depends on institutional integrity to maintain your claim. A practical question worth answering directly is how much silver makes sense as a portion of a portfolio. The Bitcoin winners making this move are not converting everything to silver. They are typically allocating a meaningful portion, The range that comes up frequently among serious hard money investors is somewhere between 5 and 15% of investable assets. The reasoning is consistent with how Buffett thinks about portfolio construction. Concentrate in high-conviction positions, but size each position so that being wrong does not end the game. Silver at 5 to 15% provides meaningful exposure to the structural case, while leaving the portfolio intact if the thesis takes longer than expected to play out. This is not a story about fear. The case for silver is not built on panic about the collapse of the financial system. It is built on a documented supply-demand gap, a historically extreme gold-silver ratio that has always eventually normalized, and an industrial demand profile growing in a structural direction that will not reverse. The Bitcoin investors who understand monetary history are not fleeing into silver out of anxiety. They are making a calibrated allocation to an asset that is measurably undervalued by specific, trackable metrics, applying the same analytical process they used with Bitcoin before it went mainstream. They are not abandoning risk. They are managing it intelligently, the way anyone who has accumulated significant capital eventually learns to do. The framework does not require catastrophe to be correct. It requires math, patience, and the willingness to act before consensus forms. The same instinct that caused someone to look at Bitcoin at $500 and say, "This makes sense, I understand the monetary argument, I will buy some," is now operating with silver. A metal with a finite geological supply. Industrial demand growing as the global energy transition continues, a monetary history that spans 3,000 years. A current price reflecting a gold-silver ratio at historic extremes. The thesis is not complicated, and the people acting on it early are the people who have already proven, through direct experience, that they can identify value before the crowd does. Think about what Warren Buffett wrote in one of his most quoted letters. Someone's sitting in the shade today because someone planted a tree a long time ago. The Bitcoin investors who are accumulating silver in 2024 and 2025 are not doing it for next month. They are planting a tree. The same patience that made them hold through an 80% crash because they trusted the long-term thesis is the same mentality driving this move. Patience is not passive. It is a strategy, and the people who have already proven they can execute it are executing it again, quietly, in an asset most people are still not paying attention to. Let me ask you something. The people who bought Bitcoin early did not need certainty. They needed to understand the argument well enough to act while the rest of the world was still skeptical. They knew they might be wrong. They bought anyway, because the risk-reward case made sense and because they had done the work to evaluate it. The argument for silver, the supply side, the demand side, the historical ratio, Buffett's documented reasoning, is available right now, in plain sight, to anyone who takes the time to look at it. The question is not whether the information is there. The question is whether you are willing to act on it before it becomes obvious. You do not have to have made $1 million in Bitcoin to follow this logic. You just need to understand why disciplined, financially literate investors rotate from high-velocity assets into structurally undervalued stores of value, and why that rotation tends to happen quietly before the mainstream conversation catches up to what the early movers already understand. The data is there. The historical record is there. The supply-demand math is there. You are hearing about it while the conversation is still happening in smaller rooms. What you do with that window is your decision. If you stayed until the end, write in the comments, "I follow the quiet money." There is another video on your screen right now, the next piece in understanding how money actually works. Thank you for watching. We will see you in the next one.